Do you know that for the last 3 years, you have been told, repeatedly and confidently, that the American dollar is losing its position as the world's reserve currency, that central banks are fleeing it, that gold has overthrown it, that the era of dollar dominance is ending, and that when you go to the actual data, published quarterly by the International Monetary Fund, the dollar's share of global reserves in the first quarter of 2026 did not fall at all? It rose. It went from 56.42% at the end of 2025 to 57.13% in the first quarter of 2026. The dollar's share of the world's allocated foreign exchange reserves increased. The euro sits at roughly 20%, a distant second where it has sat for years. Now, before anything else, nothing in this video is financial advice. This is an examination of publicly available data about the international monetary system, and you should make your own decisions and consult your own professionals. But there is something worth understanding here, and it is more interesting than the headline. Because the story you have been told is not entirely false. Something genuinely is shifting in the global monetary system. Central banks really are behaving differently than they did a decade ago. There really has been a break with a decades-old pattern. It is simply not the thing you were told it was. And the difference between the real shift and the imagined one is the difference between understanding what is happening and being sold a narrative. Start with what a reserve currency actually is, because almost everyone who writes about this assumes you already know, and the assumption is usually wrong. When a country exports more than it imports, it accumulates foreign money. When a central bank wants to defend its own currency, it needs foreign money to sell. When a country borrows internationally, it usually borrows in someone else's money. All of that requires holding a stockpile of foreign currency. The question is, which foreign currency? And the answer, for the last 80 years, has overwhelmingly been the dollar. It is worth being clear about why, because the reasons are not sentimental, and they are not about American virtue. A reserve currency has to be held in enormous quantity at short notice without moving the market. That requires somewhere to put it, an asset that is safe, liquid, and available in vast size. The United States Treasury market is the deepest and most liquid securities market that has ever existed. A central bank can move billions into or out of treasuries in a single session without materially shifting the price. There is no other market on earth where that is true. A reserve currency has to be usable. Contracts, commodities, shipping, insurance, trade finance. The plumbing of global commerce is denominated in dollars, which means holding dollars means holding the thing you will actually need to pay with. And a reserve currency has to be trusted in a specific, narrow sense. The holder has to believe that the issuing country will honor the claim, that courts will enforce contracts, and that the money will not be confiscated or inflated away on a political whim. Notice that none of these are about growth rates or trade balances or national decline. They are about depth, usability, and enforceability. That is why the dollar's share has proven so resistant to the endless predictions of its collapse. So let us look at the actual numbers honestly, including the parts that do not support the reassuring version. The dollar's share of allocated reserves peaked around 71% at the start of this century. Today, it sits near 57%. That is a real decline. It is substantial, and anyone who tells you nothing has changed is not reading the data either. But look at the shape of that decline. It took roughly 25 years. It is a slow, grinding erosion of perhaps half a percentage point a year, with quarters that go the other way, like the first quarter of 2026, which went up. That is not a collapse. That is not a currency being abandoned. That is gradual diversification in a system that remains overwhelmingly dollar-based. And critically, the money leaving the dollar has not gone where the narrative says it went. The euro has not gained. The euro's share is roughly where it has been for years. The Japanese yen and British pound are small and stable. The Chinese renminbi, the currency that supposedly threatens dollar hegemony, accounts for a low single-digit percentage of global reserves. Not 30%, not 15%. A low single-digit figure, and its growth in recent years has been unimpressive relative to the volume of commentary devoted to it. Where the share has actually gone is into a scattering of smaller currencies. The Australian and Canadian dollars, the Korean won, the Swedish krona, the Singapore dollar. This is not a challenger dethroning a king. It is a portfolio manager reducing concentration risk at the margins. Now to the claim that has done the most work in the last year, because it is the one that is technically true and almost universally misunderstood. You have probably seen the headline: Gold has overtaken US Treasuries in central bank reserves. That happened. It is real. And what it means is not what it sounds like. There are two ways the share of an asset in a portfolio can rise. The holder can buy more of it, or the price of what they already hold can go up while everything else stays flat. These are completely different events. The first is a decision. The second is arithmetic. Gold in 2026 has traded in the region of $4,000 an ounce. Consider what that does to a balance sheet. A central bank that bought no gold whatsoever, that sat perfectly still and did nothing, would still watch its gold holdings swell as a proportion of total reserves, purely because the price of the metal in the vault went up. That is overwhelmingly what happened. The crossover between gold and treasuries in official reserves was driven almost entirely by valuation effects, not by central banks selling American government debt to buy bullion. And you can verify this independently, which is the useful part. If central banks were genuinely dumping treasuries, it would show up in the dollar's reserve share. That number is computed from currency composition, and it is not distorted by the gold price at all. The dollar's share went up. Both things are true simultaneously. Gold's share of reserves rose sharply, and the dollar's share of currency reserves also rose. There is no contradiction, because they are measuring different things. Anyone presenting the first as proof of dollar abandonment is either not reading carefully or is counting on you not to. Which brings us to what is genuinely happening, the part that is real, that is a break with history, and that deserves your attention far more than the reserve share headlines. Central banks are buying gold at a rate not seen in modern financial history. Purchases have run above 1,100 tons in recent years. For context, for most of the 2 decades after the Cold War, central banks in aggregate were net sellers of gold. They were getting rid of it. It was regarded as a relic, an asset that pays no interest, costs money to store, and does nothing but sit there. That reversed, and then it accelerated, and the buying is not coming primarily from the wealthy Western economies. It is coming from emerging markets, and disproportionately from countries with reason to consider their relationship with the American financial system. Ask why an institution would want an asset that pays no interest and costs money to store. There is exactly one answer. Gold has a property no other reserve asset possesses. It is nobody's liability. A treasury bond is a promise from the United States government. A euro deposit is a claim on a European institution. Every financial reserve asset in existence is, at bottom, somebody's obligation to pay, which means it can be frozen, sanctioned, or refused. Gold in a vault inside your own borders cannot be switched off by a foreign government. It has no counterparty. It has no settlement system that anyone else controls. That is not a return on investment. That is insurance. To understand why that insurance suddenly became desirable, look at 2022. When Russia invaded Ukraine, the United States and its allies froze roughly $300 billion of Russian central bank reserves. Not a private bank's assets, not an oligarch's yacht. The foreign exchange reserves of a sovereign central bank, the very war chest that reserves exist to be. That action was, from a Western policy standpoint, entirely defensible. It was also the single most consequential monetary event of the decade, and its effects will be felt long after the war ends. Because every finance minister and central bank governor on earth watched it happen and drew the same conclusion. Reserves held in the Western financial system are not unconditionally yours. They are yours contingent on your relationship with the country that issues them. For most nations, that contingency is irrelevant. But if you are a country that can imagine, even remotely, ending up on the wrong side of Washington, the calculation changed permanently in 2022. The response was not to abandon the dollar. There is nowhere else to go at the scale required. The response was to build a hedge, to move a slice of reserves into an asset that cannot be frozen, while keeping the overwhelming majority of the portfolio exactly where it was, because there remains no practical alternative. That is what the gold buying is. It is not a bet against the dollar. It is the purchase of an insurance policy against a specific political risk that was theoretical before 2022 and is not theoretical now. The second real development is slower, less dramatic, and probably more important over a 20-year horizon: the plumbing. Reserve currency status is not only about what you hold, it is about the rails your money travels on. For decades, cross-border payment has meant the Western messaging and settlement infrastructure, which means transactions are visible to and ultimately interruptible by the authorities that oversee it. China has spent years constructing an alternative payment system for renminbi settlement, and its usage has grown substantially. Other arrangements have appeared: bilateral trade settled in local currencies, oil and commodities priced outside the dollar in specific corridors, regional payment agreements that bypass the traditional route. Individually, these are small. Collectively, they represent something that did not exist 15 years ago: a partial, functioning alternative set of rails. Here is why that matters more than the reserve numbers. A reserve currency's dominance is a network effect. You hold dollars because everyone prices in dollars, and everyone prices in dollars because everyone holds dollars. The whole structure is self-reinforcing, which is exactly why it is so stable and why predictions of its imminent collapse have been wrong for 50 years. But network effects work in reverse too, and they do not unwind smoothly. They unwind slowly, then suddenly. Every transaction that settles outside the dollar system makes the next one marginally easier. For a very long time, nothing appears to happen, and the change, when it becomes visible, is already well advanced. That process is genuinely underway. It is also nowhere near the threshold where it threatens dollar primacy, and honest analysis has to say both halves of that sentence. So what would it actually take to dethrone the dollar? Not decline in America. That is the assumption underneath most of the commentary, and it is wrong. Britain's economy was overtaken by the United States decades before sterling lost its reserve role. Reserve status is sticky far beyond the economic fundamentals that created it. What it takes is a replacement. And a replacement has requirements that are brutally specific. It needs a securities market deep enough to absorb trillions without moving. The Eurozone does not have one, because it has no unified safe asset. It has German bonds, and Italian bonds, and Greek bonds, which are not the same thing. And that fragmentation is precisely why the euro stalled at 20%. It needs open capital markets, money that can leave freely. China maintains capital controls. A currency you cannot freely take out of the country is a currency no central bank can rely on in a crisis. And Beijing has shown no intention of abandoning those controls because they are a core instrument of domestic financial stability. It needs legal enforceability, independent courts, and predictable treatment of foreign creditors. And it needs the issuer to accept a genuine cost. A reserve currency issuer runs persistent deficits because the world needs its paper. It accepts a stronger currency than its exporters would prefer. Every serious candidate has looked at that bill and declined to pay it. There is no currency today that meets those conditions. That is the whole answer. not American strength, the absence of a qualified alternative. So where does that leave you? The throne is not gone. The data says the opposite of the headline, and it says so in the most authoritative source available. But three things are true at once, and the discipline is in holding all three. The dollar's share has declined meaningfully over 25 years at a slow and undramatic pace into a scattering of minor currencies rather than to any challenger. Central banks have made a real historic break with the past by buying gold in size, not as a bet on gold, but as insurance against a political risk that materialized in 2022 and will not be unmaterialized. And alternative payment infrastructure is being built patiently, and network effects do not announce themselves before they turn. What should you actually watch? Not the gold price, which tells you about sentiment and valuation. Watch the currency composition data, the real quarterly numbers, not the commentary about them. Watch whether the Eurozone ever creates a genuinely unified safe asset. Watch whether China ever opens its capital account, because that would be the first credible signal in 50 years. And watch the share of global trade actually invoiced outside the dollar, which is a far better indicator than reserve holdings because invoicing is where habits are formed. The lesson underneath all of this is not really about currencies. It is that the most confident narratives are usually the ones that have stopped checking the data, and that the genuinely important shifts are almost always slower, quieter, and less dramatic than the story being sold about them. The dollar did not lose its throne this year, but the world spent the year buying insurance against the day it might. And insurance is not bought by people who expect nothing to happen. Again, none of this is financial advice. It is an argument for reading the primary data before you accept the headline. That habit is worth more than any prediction in this video.